when I look at what is happening right now is the container volume that would have come over from China. And again, this is a China story. I think we've talked about this is like everything else is secondary. Like the 10% tariffs are going to be absorbed in the economy. Most businesses can afford that. Those are just secondary actors. The whole world is on China and the United States. So let's talk specifically about that. The volume that would have come over from China is not coming. And that is showing up right now. This is the week, late last week was sort of the first time where that volume that would have come over has not come over. And now we're sort of in the thick of it where we are seeing a lot of volume drops, sharp volume drops, and this is going to play out in the next couple coming weeks. Is volume that would have been here is not here, and so let's talk about what happens. So, container volumes don't show up. It's 500,000 people in Southern California that work in logistics. They're just simply not going to have as much work. So the ports, union contracts have a little bit more sort of staying power. They can do maintenance around the port, but then you got this sort of dependency of the truckers that are in and out of the ports. They're going to see a sharp drop. So the number of orders, the number of loads, the number of container boxes that they would be shifting from the port to the distribution centers in Southern California just aren't going to be there. So you're going to see just reduced order count and reduced. You're going to see some layoffs. We've already seen it in logistics. UPS has announced 20,000 layoffs. Penske's announced layoffs. And so we're starting to see layoffs start. We're in the very early innings of it. Containerized imports into the United States represent about 20% of the trucking volume. And trucking is an industry where labor is directly correlated to demand. There are very few economies of scale in trucking. So it's an industry that the throughput of volume does drive the employment picture. So if I reduce 20% or I reduce 35% of my 20%, I'm off about 7%. And so that means I'm likely to see an equivalent reduction in jobs in logistics. There's 9 million jobs across the United States that work in logistics. And so I think it's fair to say that a minimum of 400 to 450,000 jobs will likely be lost in coming weeks that work in the logistics industry. It could be bigger than that. Depends on how pervasive this goes through this economy. But in coming weeks, you're going to see some sharp reductions in workforces in the logistics sector that's going to show up. As we shift into the calendar and we move into, so that's all in the logistics sector. They're sort of on the front lines. They're going to fill it. They're already filling it. In the coming weeks and perhaps a couple months out, this is where those orders that would have been sent over start to show up in inventories. And it'll be slow at first. In June, you'll go to the store and maybe your favorite product preference isn't there. The color that you're buying isn't there. Maybe intermittently, maybe you've got an e-commerce website that you're used to buying something and they just don't have your products or your selection or your size. That will happen, but you're not going to really feel it. I think the first time consumers really notice it is back to school, because that is the first season. Those products would have come over in April and May, and they're simply not in inventory. And that's going to be the first season where I think broadly consumers start to notice that there is a shortage of selection and inventory stockouts in that sort of back to school timeframe. So that's early August. And what's happening is companies had ordered these products from the contract manufacturers in China, and then they didn't want to pay the 145% tariff or couldn't pay the 145% tariff. So they put all those orders on hold. They just basically contacted their suppliers and said, "Don't ship the products to me." So all the products that these contract manufacturers had produced basically stayed either in the warehouse or the factory and are piling up in China with nowhere to be sent. And those products are what you're going to start to see in coming months that are not showing up in inventory. It gets more interesting. So that's sort of phase one. I think phase two is actually more interesting, because phase two is the fact that new contract orders we've talked about, and phase one can be corrected really, frankly, pretty quickly. So let's say we get a trade deal in a couple of weeks. Those orders that would have come over for back to school can easily be sent over, and inventory stockouts just probably aren't a major concern. But if we get into later into the calendar and we're starting to look in July and certainly August, this is where would be orders are a problem because what's happening is US companies are not placing orders to Chinese contract manufacturers. And because they're not placing orders to contract manufacturers, the lead time, if we were to get a deal, would be measured in months, not, it would take about a month to sort of put the economy back in line and those products that were ordered to come back and flow over. It's approximately a month. We can be back in order and it would be, I wouldn't call it a non event, but be pretty uneventful for the most part. I think in 2 years, we would have forgotten that it's even happened. But if we get into a situation where we don't have a deal by July or August, it sort of resumes the flow of cargo and resumes the order flow into China. That's where I would be really concerned about the holidays because you think about the fact that it's basically a 4 month lead time for the time that, at best case, the time people order product to the time they ship it. Then you're dealing with a situation of having some enormous amount of inventory stockouts come the holiday season.